everyone, welcome back to Finance Magnates interviews. We're here at the beautiful Amathus Hotel with Myria Evdokimou, CBDO of Exclusive Capital. Welcome, Myria.
Thank you very much, Andrea. Thank you for having me here.
It's a pleasure. Today we're here to talk with Myria about portfolio management and funds. A lot of fun. So tell us, Myria, can you tell us a little bit about your experience, first of all?
Sure, absolutely. So I started my career around 14 odd years ago now. Seems like a long time. At a reputable hedge fund. And the last 10 years of my career have been spent in London, where I worked for various asset managers and investment firms in different roles, including business development roles, sales, client relations, client experience management roles. My most recent role was at BlackRock, which is the biggest asset manager in the world, and there my role was to manage multi-billion-dollar accounts for the firm.
Multi-billion, with B.
Multi-billion, yes. As BlackRock having 7 to 8, actually it's 8 point something now, trillion of assets under management. You can imagine that their clients are huge, huge institutions, huge pension funds and insurers and big investment banks. So so we split it between us. The big accounts were given to each one.
And so what is your role currently?
So my current role at Exclusive is, as you said, CBDO, Chief Business Development Officer, and my role there is to develop, oversee, and promote and distribute portfolio offerings and the fund to external investors.
Perfect. So what is EXCA Fund?
So the EXCA Fund has come as a natural progression of our existing operations, and due to the demand from clients and what we're seeing in the market, what client needs are. So the fund is registered in the RAIF register under the Cyprus Securities and Exchange Commission, so it's a registered alternative investment fund. So with that, there's an open-ended umbrella investment company of variable capital, and under that there's different compartments, sub-compartments, sub-funds as we call them. So we've created one sub-fund called the EXCA Absolute Return Fund. And the beauty of this kind of structure is that we can create as many sub-funds as we need in order to give something else to the investor. So it could be a different type of strategy altogether. It could be, let's say, the next one could be a property fund or real estate, some other sort of sub-compartment. At the moment, we have the Absolute Return Fund, and the objectives of the fund is to generate absolute returns to the investor. And what I mean by that is, irrespective of market conditions and the direction of the market, irrespective of what the benchmark is doing, then this fund is set, it has its own objectives and targets and the way it structures itself, its own strategy, let's say, in order to generate the required returns for its investors.
So how is the mix and the decision making made on the strategies of this fund?
So the mix is decided by an investment committee. And our investment committee consists of around 8 persons at the moment. Each of those people have extensive experience in investment research and in the financial industry, and together they have an experience of about 150 years between them. So they are responsible for deciding what goes into the fund in terms of which strategies to use. We try to provide strategies, find strategies that complement each other, and therefore provide the fund with less volatility in times of a lot of volatility within the market, and also try to reduce the risk.
Because ideally, any fund strategy would be lower risk and higher rewards.
Well, no, it really depends. So it depends on what the target outcome for each type of fund is. This fund is focused at generating returns for its clients using a diversified set of strategies, a diversified set of objectives that complement each other. So the more you diversify within the portfolio, the lower the risk is and the lower the volatility is. As we know, lower the volatility, they usually say the higher the volatility, higher the returns, lower volatility, lower the returns. So it's about having that balance of what you're trying to generate for the client.
So what is exactly your type of client for the funds?
So the clients that this fund is addressed to is well-informed or professional investor. So what we mean by that is investors that know about the markets, they know about financial instruments, they know about the risk-reward ratios, and they know what they're getting themselves into in terms of the different asset classes that we invest in. Professional investor is usually a regulated body in a sense. Well-informed is one that isn't necessarily regulated at all, but has that background knowledge and can be seen by a governmental body as being adequate to invest in the fund.
So how about me? Can I invest in the fund, me personally? Yes, Andrea.
Well, there's a minimum. If you have a lot of money sitting in your bank and you can invest the minimum of, you would classify, let's say, if you would classify as a well-informed investor, you would need about 125,000.
Great. So that's a minimum to participate in the fund.
As a minimum to participate in the fund, as a well-informed investor. So it all depends on your
One day.
on what you have.
One day.
But what I do want to focus on is that irrespective of whether it's a well-informed or professional investor, what the investors that this fund is addressed to is ones that really do favor medium to long-term view. And what I mean by that is that this fund, because of the diversification within it and because it tries to disperse risk and volatility by adding to different sectors, to different geographical locations, different time horizons within the fund, different asset classes within the fund, these type of funds tend to do well in the long term, with a long-term view, and they have exponential growth with the compounding effect of the profits that go back into the fund.
Long-term period, consider as what?
Look, you could say from about 3 to 5 years would be considered medium to long term. That's not to say that an investor with a smaller time horizon can't invest, but they should keep in mind that more returns could potentially be generated if they were to stay longer term. To give you an example, one strategy that we already have running that will be incorporated in the fund can generate 15, 20, 25%, let's say, as annualized return. But
Wow.
If it has so far, more or less, most of the years. But what I do want to stress is that when you do the cumulative return, cumulative meaning the total return since inception, which is 2015 for this strategy, it's generated 213%.
213% return from inception.
Compounded. So this is what I
outstanding.
mean by long-term view. So the profits go back into the fund and it's compounded.
So just to clarify this point, so if I had invested 125k, me as Andrea, in the fund in 2015, now 6 years later, I would have made 213% profit on that?
Well, this is just one strategy of the fund, obviously.
On that strategy, I'm
obviously
stressing.
Obviously the fund isn't from 2015, it's just this strategy that we're adding because it's a good performing strategy. But if you, let's say,
If I had,
if you'd
hypothetically.
invested in the strategy, because the strategy has been running at exclusive since 2015. So if you invested in the strategy, let's leave the fund aside because it's new.
Yeah.
Then yes, your investment would have returned about 213%.
That sounds like the best investment of my life. I wish I had done that. Anyway, so just to recap on the types of clients and the type of people that can invest. So let's say for our industry, because at the end of the day, that's what we're here for, right? So in our industry, we can have either institutions that take, let's say, part of the profits of the let's say I'm a broker, right? So I have several profits monthly or whatever, so I could take them, invest them in the fund or in strategies, and I follow the strategy, get a certain return as an institution, or me as, for example, UBO or CEO of a given company. I also have my interest, my return, etc., and this seems like a good place to put that extra cash that can generate a return in the medium longer term, and that would be managed by the XCAF fund as a general.
So what happens is you have to take each investor separately in terms of you have to classify them, not only well-informed or professional, but also classify them. Are they an individual? Are they a corporation, as you mentioned? And then they register to the fund if they're happy with the objectives of the fund and what it's trying to do. If they agree with the philosophy of the diversification within the portfolio, if they understand all of this and understand the risk implications of investing in any sort of
course,
security. Yeah.
We all know it. We're in this industry. Everybody knows investment carries risks.
Yes. So once all the checklist is done and they can transfer their assets within the fund, then it is purely up to the fund manager how they allocate within the portfolio. And the fund manager always has in mind to allocate where they see the best potential to generate the best return. Obviously, that's why the allocation is always done from the investment committee and the fund management group, and managing the risk as well. So the risk is also done by the fund managers.
So you mentioned that you have within the fund multi-investment strategies. Can you please elaborate a little bit on the actual methodology for it?
Sure. So basically the fund takes positions from a macro and microeconomic aspect point of view. It considers fundamental analysis as well as technical analysis. I mean, I don't want to bore you with too much of the details, but for example, one of the strategies is a bottom-up strategy, so looking at the fundamentals of each. It's an equities-based strategy, so looking at the fundamentals, so bottom-up approach, looking at things such as balance sheet and cash flow. There's other strategies that take a top-down approach, a more tactical asset allocation, so change their allocation when they see fit, when they see the market is moving towards a particular trend. So there's various type of styles. It's what I said before, that we try and find strategies that complement each other and therefore give a balanced and diversified portfolio overall for the client.
And the very interesting part is, when it comes to funds, what kind of responsibility has a fund have towards its investors?
Well, the fund, it's regular. So the fund under the RAIF structure and through its fund manager, the AIF, it needs to follow a set of rules and regulations that qualify under SISEC and under the European standards as well. So that aside, which is common practice and what you're supposed to do, a fund has responsibility to safeguard the client's investments. So it is the fund manager's responsibility to look after the portfolio, to do what it says on the tin. We say in the UK quite a lot. So basically, what the prospectus says, what the offering memorandum that you've given to the client, that he understands what type of securities you're going to invest in, how you're going to invest, how you're going to manage risk. So you need to follow what you've actually set out in the proposal to the client. So that's key to any sort of fund, and how they should look towards their responsibilities for their investors. Transparency is key. Like, we always talk about transparency at Exclusive, because this is what investors want. They want full transparency as to what are you doing with their money, how are you putting it to good use in order to generate returns. We have to keep investors informed at all times, so this is something that I'm very adamant about. Keeping our investors who have given a portion of their money to the fund, keep them updated about what's happening in the market and how the fund has performed, whether it's outperformed or underperformed, to explain why, and to give them all the fact sheets and insights required, so they feel comfortable about where they've placed their money.
Mm-hmm.
So all that together, and we always try and align the interests of the investor to the interests of the fund manager. Therefore, for example, the performance-related fee that we have with the fund, it's always subject to a high watermark. So we will not claim fees, performance fees, if we do not outperform, if we do not generate profits for our investors.
So the more profit you generate for your investors, the higher the fees. Therefore, the interest of the portfolio manager to perform the best they can.
The fees are standard. So on this fund, the fees are 220, which is quite the norm for a fund. 2 meaning that management fee that all the investors pay is about at 2%, and performance fees at 20. This is just a general figure. So if you have investors that will invest more than, let's say, 2 million, then the fee goes down. So it always depends about how much the investor is actually going to invest. We have 5 different share classes. 3 share classes are Euro share classes, and they depend on how much the investor is going to invest with us initially, and so what the fee structure will be. And then we have a US denominated share class and a GBP denominated share class. So it is in our best interest to make a return for the client and for ourselves in order to acquire the performance fee.
So till now we have mostly discussed about the fund and the strategies within the fund and everything, but you do have strategies independent from the fund, right?
Correct, yes.
You did mention one, I believe, but do you have any others?
Yes, so we've already mentioned the one that is it's called the small mid value cap fund, which focuses on equities within the portfolio. So what that fund tries to do, it tries to look at overvalued, undervalued, or mispriced stock within the market, and look at the fundamentals behind each stock to see whether it's a concrete, solid stock, solid company that the fund manager believes will at some point outperform and would generate more of a market value. So that's the one I said that has about 5 years of track record, and since 2015 the cumulative return has been 213% on that. So that's the one that we discussed before. We have other what we call model portfolios. Those are global volatility portfolios. We have a Euro, a GBP, and a USD. And they're split into 3 types of volatility. So it's low volatility, medium volatility, and high volatility. So it all depends on the client's risk appetite. So if you're a client that has very minimal risk appetite and doesn't want to risk too much in order to get the high return or high risk at the same time, you would potentially consider the low volatility model portfolio. We have a medium one, being of medium risk, medium volatility, and a high volatility portfolio. So it's all about asking the right questions to the investor, seeing what their risk appetite is, seeing what how they want to how they want the portfolio to work for them, and then decide which portfolio to add them to.
So more in a consultancy kind of basis.
Yes, we
you
need
really
to
need to understand your client.
If they're interested in this strategy, we need to know what their level of risk is, so we can propose the most appropriate model strategy of the three. And what this strategy looks at is basically investing not directly in the securities themselves, in the underlying asset classes. They invest in funds that invest in different asset classes. So you have the likes of BlackRock in there, BlackRock funds, Schroders, AXA funds, the very well-known industry funds out there. And you have a very mixed bag in terms of sector breakdown, in terms of geographical location, in terms of asset classes, and the different instruments used. And it uses a more of a tactical asset allocation approach, so it allocates and reallocates within the portfolio and reshifts the allocation according to what's happening in the market, according to some trends, according to where they see they can sort of outperform within the market. So it's constantly tweaking and changing the allocation of the existing portfolio, and that's what we mean by a tactical asset allocation within these model portfolios.
So these model portfolios or strategies are actually something that it's independent from the fund, and is it something that, let's say I'm a broker, is it something that can be white label that I can use? Because I'm thinking, I'm a CEO of, let's say, one of the big brokers out there, and I have a set of traders that I know would be highly interested in diversifying their portfolio and using these kind of strategies. Is it something that you offer in a B2B level so that I can offer these strategies to my trader, for example?
So we do have white labeling potential. It always depends on which strategy the client is going for. So we have to sit down and consult with them to see which strategies can be white labeled, which ones have more of a complexities that we need to sit and consider and negotiate with the client. But yes, overall, most can be white labeled.
That's a novelty in the industry. I don't think this has been done before in the industry, right? To take strategies that are actual investments in the market and promote them to my set of traders. So obviously the technicalities, if somebody's interested, they would contact you directly.
Absolutely.
And you would develop on what the technicalities are. But bottom line for me to understand basically is that you have a set of strategies to invest in different funds and portfolios, etc. And if I am a broker, I can incorporate these strategies and promote them to my traders so they could be investing in those strategies to diversify their portfolio, which is pretty innovative, I must say.
So the idea behind this is that we have portfolio managers with a lot of years of experience and knowledge within the market. A lot of them are economists themselves. So they have high conviction within portfolios within particular asset classes that each one, targets and looks at. And the idea is that what the brokers can do is acquire that expertise by either investing directly within the strategy or somehow white labeling it to suit their needs, and therefore being able to have a piece of the pie within that strategy.
And what is the next? What is the company outlook for the next year or so?
Well, the company has come such a long way in terms of it's grown intrinsically and exponentially within just a few years. So it has a 30-year heritage behind it, sitting in the financial industry, but exclusive capital has come such a long way in such a short amount of space and time, and that's because of the the demand that we're seeing from our clients, the fact that we've been able to get our name heard and be able to give clients what it is they need, or at least sit and listen to them and understand what is missing in the market and try to adapt and evolve and change to meet client expectations. So we're a multi-asset boutique firm, but we want to get to a place where we're the preferred multi-asset boutique firm. And things are looking great for the company. There's so much growth potential, and there's so much demand from clients, and that is why we've created the likes of a fund, because we see potential there, and we don't want to stop. So within the next a year or two, or for the foreseeable future at least, what we want to do is continue creating new ideas, new strategies, and incorporating them within our existing portfolio offering. We want to add other subcompartments to the fund. As I've explained, we have one at the moment. We want to add others in different kind of more niche asset classes, potentially. We want to expand on all our offerings, and we want to do this in a way where we still keep the value, maintain the value that we have, and the client experience. So client experience is number one for us. We talk about this every day. We always say client comes first, and we need to show that a client isn't just a number, basically. We want to treat each individual client as though they're the only client. Mm-hmm. And this is how it should be, and this is where smaller firms can do just that, because we're much more nimble, we have a flat structure, we can turn things around quickly for the client, we can really spend time getting to know the client and understanding their needs, and then being able to adapt what we already have to provide that extra level of service to them. So we plan to continue growing. All the teams internally have grown since I've been there. There's so many other hires that have happened, and I'm just amazed at the demand. So we will continue adding expert personnel within our existing employees in order to boost the client experience, and also continuing to partner with huge corporations across the world to be able to cater to not just Europe, but to the Middle East, to Africa. So this is the direction that we want to take. We want to do things obviously on a step-by-step level. We don't want to become too aggressive, but our target is to provide excellence to the client, to stay in line with the client, and see what the demand is, and shift and change according to the demand of our investors.
Great. So now, before we finish, I actually want to ask you, could you give 3 tips mm-hmm. to all our investors out there and business owners as well?
Okay, so these are my 3 tips in terms of my experience and the different type of investors that I've had the pleasure of working with. Basically, I would say always consider your risk tolerance before you consider any sort of investment. What you don't want to do is get yourself in a fund or start investing in something that you basically don't have the risk appetite for, and find that you're losing money instead of trying to grow your capital. So it's very important that you understand what your risk level is as an investor. The second one, think long term. Don't try and speculate on the market. Don't always focus on the short term. There's highly paid analysts out there that are speculators, and this is the speculative momentum investing, and even they get it wrong, because it's really hard to speculate on where the market direction is going at times. So being, let's say, a simple investor or one that is either less knowledgeable or going into the industry now, don't try and speculate. Look at the long term and look at the potential of investing in a fund or a strategy that is more of a long-term horizon, because, as I've said, you get to see your returns with a compounding effect as the profits add up and get reinvested within the fund or the strategy. And my third, and I think the most important, I keep on saying this, is diversification is key. Diversify, diversify, diversify. So a balanced portfolio is one that usually performs best through the long term. So diversify in terms of your asset allocation. Invest in all types of securities, whether they're stock, fixed income, alternatives, some cash investments, property. Just look at the overall market and try to diversify your risk and your volatility by looking at all of these asset classes. Diversify in terms of sector. So go into different types of sectors. Therefore, if one sector is not performing well within an industry at a given time, then you've always got the other sectors to fall back on. And also geographical location. Don't invest, let's say, just in US. Invest in other geographical locations as well. So in that way, you have a more balanced approach. And given current market conditions, as you see now after everything that's going on with the pandemic, you see a lot of volatility in the market, and you need to be able to manage your capital in such a way where you're not too exposed to the market and the volatility of this. So diversification is key. That's what I would say.
Thank you so much, Myria.
Thank you so much for having me.
These 3 tips I'm definitely taking note of.
Thank you so much. And of course, our doors are always open 24/7. You can find me, and if anyone wants any further explanation about anything that we've discussed, then I'm always available.
Most definitely. Thank you so much for coming, Myria.
Thank you very
Great
much.
having you guys. Great having you, Myria. We'll speak soon.
Thank you. Have a good day.
You too.